Saturday to share some really good education with us, teach us about historical probabilities and trading the opening gap. So at this time, Scott, I will turn things over to you.
All right, thank you very much, Morgan, and good morning or good afternoon to everyone, depending upon where you might be. My name is Scott Andrews, and I have the very tough position of following Steve Bigelow. I am not nearly as funny. He's a fantastic presenter, and actually, I think he wrote the second book I ever read on trading, Profitable Candlestick Trading. It's an outstanding book, I can tell you firsthand, and I still use candlesticks in my own trading and even research. So I'm delighted to be here. I do appreciate the opportunity, Morgan. I'm going to talk a whole lot about gaps, probably more than you've ever heard, at least in terms of data about trading the opening gap. I am a gap fader, meaning I short opening gaps if they're up, and I buy opening gaps if they open down, meaning lower than the prior close, generally targeting the prior day's close. So I'm in the trade, in and out, same day, and I'm only trading when there is a clear historically based edge. And what I mean by that is not based upon some observation. I don't have the decades of experience Steve had, for example, in interpreting charts and price action, but I've supplemented that over the past 10 years with doing, one could argue, exhaustive research using backtesting systems, Excel databases, and so on. So I'm going to share a whole lot with you over the next 45 to 50 minutes. I love questions, quite frankly. I have a lot of information, though, so feel free to fire away. I ask that your questions be relevant to the slide that I'm on, and I will do my best to answer. We have a whole lot of people in here, and hopefully we'll have a few minutes at the end to answer any follow-up questions. So I'm going to continue and just power through all of this that I can. I'm also going to show you, let me see. Oh, there's the obligatory disclaimer. I will say this is important. I have all this information I personally put together. I did all the research. I believe it to be accurate. I use it every day in my own trading, but you need to use this information at your own risk, okay? So hopefully that is very obvious. I'm very honest. I work hard, but there's a mistake in here somewhere. But I think you'll find it very helpful. And for those of you that may have to cut out early since it is lunchtime, I did want to share a link where you can get a copy of these slides because there's going to be some fair amount of detail. You can also get a bonus video that will build upon this presentation called 8 Gap Facts Every Trader Needs to Know. Just got to enter your name and you can have access immediately. And I've also got a special offer at the end for those that really want to learn more about gaps and trading with probabilities. And that link, by the way, should pop up in just a moment. So here's what we're going to cover. I'm going to cover the basics of gaps to make sure we all have the same understanding, or at least you understand my terminology that I'm using so you can interpret this data and hopefully put it to good use. I'm going to talk about how I trade gaps. And it's important that you note I don't say how to trade gaps. I say how I trade gaps. There are many different ways to trade gaps. There is no right or wrong. And that's important because you need to tailor the information I'm going to share with you for your own goals, risk tolerances, personality traits even. So keep that in mind. I'm going to go specifically into my selection criteria, and I'll even cover some tips on execution, how I go about it. Again, try to stretch your thinking conceptually about how you approach trading. In fact, in general, I have 2 primary goals today. I want to share some actionable information, meaning some specifics that are historically based data points that you can remember and use to avoid riskier setups and capture some of the better setups. And secondly, I want to share concepts that may make you rethink about your own approach to trading, because what I do, as you're about to hear, is a little bit different. I am not a discretionary trader, meaning an indicator-based, chart-based trader like Steve has clearly mastered. Um, but I'm not a systematic trader. I don't trade based upon a mechanical system, even though I do have one or have multiple mechanical systems. I'm actually what I think I get to take advantage of the best of both worlds. I'm a probability trader. I'm somewhere in between. I'm more systematic than discretionary, but I do have some elements of discretion that allow me to take advantage of historical probabilities. So uh, keep that in mind as we go about, and I hope you enjoy what I'm about to share. So what does a gap look like? There's one gap, good old David Letterman, but that's not what you came here to see. Here's a gap of the Russell ETF. It's on a daily chart, and red candlesticks here. We closed at 48.38. This is actually several, maybe 4 or 5 years ago. The next morning we gapped down on the 12th. You see the wick? Intraday price action rode all the way up to 48.38, actually precisely, and then rolled over and finished weekly. Not uncommon. So just because a gap has a strong historical probability of filling the gap doesn't mean that it has a high probability of continuing in that direction. In fact, often gaps will reverse. Now I'm fading. I'm looking to buy down gaps if it's a good setup. This would have been a scary one, or sell up gaps if there's a clear historical edge. Now this is what a gap looks like on a 5-minute chart. The white line is where the market opened. This is the Russell. And you can see the next day it basically traded straight down from the open on these 5-minute candlesticks, going all the way to the blue line, which is the prior day's close. You could use 4 p.m. for like the ETF, 4 p.m. Eastern time that is, or 4:15 for the futures. Now, again, if the gap had been down, I would have considered buying the gap and targeting gap fill. This is called fading the gap, though, had I entered. I don't remember if I've traded this one or not, but that would be fading the gap, going the opposite direction of the overnight move, because it's that overnight move on low volume, right, in the futures markets based upon macroeconomic events around the world that creates the opportunity, because it's low volume that creates the overnight price movement that then I, as a gap trader, can take advantage of. In fact, quite frankly, all I'm really doing is piggybacking on what big money, Wall Street, has shown that they are likely to do in different scenarios for trading the gap. Now, I started off as actually was fortunate enough to take a company public in the late 90s, right place, right time, right story, built a great company, stepped down about 10 years ago and went straight into trading. So I had a firsthand view of how Wall Street works, and it was intriguing and, quite frankly, scary, as many of you that were around during the dot-com days likely remember. I knew first and foremost I would never be a buy and hold investor based on what I'd learned. Plus, it didn't really suit my personality. I was fortunate enough to have a little time, a little money to dig into trading. So I started off swing trading, trying to essentially time the market, and realized within about a year that it was too dependent upon too few trades for me. I had to be an expert at timing the market, which is extremely hard to do because you can't predict what may happen with interest rates, a whole host of factors that impact the timing of a market that just are unpredictable. So I wasn't very good at that, and I realized I needed to trade more actively, but I did not want to be a day trader. I didn't want another job. So what I ultimately ended up doing was recognizing that there are opening gap opportunities that happen just about every single day. And often the biggest move of the day is at the open, right? So that creates a tremendous opportunity to get in. If you can use the leverage of futures or margin or options, you can take advantage of that initial opening move. And I could study them exhaustively, as I mentioned, which is what I did, to identify the best and worst scenarios historically. So that's how I came to be a day trader, if you will, but I don't think of myself as a day trader. I'm building, fairly sizable positions, a significant percentage of my liquid net worth that I'm trading with, but I don't trade real frequently. And I'll share you some details, some extra specifics on how frequently I trade and my results in a bit. But let's continue on here. I call it the easiest trade of the day. Let's be clear. There is no easy trade, right? In the grand scheme, they're easy trades. It's not easy to make money, is maybe what I ought to say. But in terms of trades, I think the opening gap is a superior setup to, frankly, every other intraday opportunity that may exist. They have an inherent bias. Don't take my word for it. I'm going to show you the actual data. 70% of all opening gaps will retrace back to the prior day's close on the same day that they are created. 70%. All opening gaps across all indices. That's based upon the U.S. indices I've studied the most, the S&P, the NASDAQ, Dow, and Russell. So it's a setup that has the wind at its back. Even some of the mediocre setups have a good probability of filling. So that's a built-in bias, and that's an advantage. You can prepare in minutes before the open. Before I started a blog about 5 years ago and started sharing some of my research with folks and turned into a full-blown education site, I'd literally, I'd have the TV on in the morning. I'd go for a walk, get the kids off to school, and I'd sit down 9:15, 9:20, 10, 15 minutes before the open, look at my data, and decide on a very binary basis to either pull the trigger or not that day based upon history. You can trade without charts from anywhere. I have traded gaps, I won't say all over the world, but just about. So I've traded them on the beach. I've traded them at convenience stores, gas stations, airports, hotels. I don't think I've traded in the woods camping yet, but I'm very close to doing that. I love to camp with my kids. You can do it from anywhere. You don't need charts. You just need to know where the gap is occurring, what the price level is as it relates to the prior day. And if you have some simple rules, you can trade the gap. The opening volume is normally very high, so it's a very liquid opportunity in the morning. That's another advantage. You can fire, forget, huge advantage, meaning I place orders. I love to day trade, by the way, and I do okay, but it's taken me about 10 years to get to the point I'm consistently profitable on my discretionary day trades. The real advantage and the real secret, though, trading with historical probabilities in the gap is that you set up your order with a predefined target and a predefined stop. And I'm going to talk about where I put those in just a bit. But using a military analogy, if you will, I am ex-military, you can fire and forget. Okay, make the decision, go about your business, check on it by the end of the day. The risks are limited and controlled. No overnight risk. It used to drive me crazy as a swing trader that I was always constantly worried about big positions that were on overnight and their exposure to any global events. And they work in bull and bear markets equally well. I've done as well or probably better during bear markets even than bull markets. So you can do very, very well as long as the market's, well, even if the market's not moving. I prefer it when the market's moving, but even sideways markets you do well because the actual win rate for gap fills goes up. So you don't have to predict the market's next move, and that was really important to me. That's probably the most important advantage in my mind. They're market neutral. Most setups are not really market neutral. Some definitions. Fade, as I've mentioned, is to trade in the opposite direction of the gap. Gap fill is when price retraces from the open of one day back to the prior day's closing price. Win percent, as I talked about that, is the percent of opening gaps that have faded at the open, fill the gap, or at least end the day profitable. Okay, right? Sometimes it won't actually fill the gap, but as long as it finishes inside of the opening price where you were filled, then it's considered a winner. Profit factor is a simple way to express whether or not a setup has been profitable historically or not. It's a ratio of the gross profits from the winners divided by the gross losses from the losers. And if it's more than one, then it's made money. If it's less than one, it's lost money. It's that simple. The bigger the number, generally, the better. I trade the E-mini S&P futures. You may hear me mention the ES. For those that don't trade the futures, fantastic, highly liquid, arguably the single most important, S&P futures that is, single most important market in the world. Tends to lead certainly the U.S. indices. If you had to pick one market, I think it's where the big boys play. But if you are armed with good data and you have good money management and good discipline, you can do extremely well. And then ATR, I use volatility adjusted stops, which you'll hear about in a moment. They're based upon the average true range, which is simply the average range between the high and low of each day, inclusive of the opening gaps. If you get a big gap, it would include the two extremes, the prior close or the higher low of the day versus the higher low of that day. So inclusive of the gap. All right, let's get to the good stuff here. Now, I'm a data geek, okay? So you are forewarned, and I've taken it a little bit easy in this presentation on data. The free download I mentioned that you can get, add that link to someone who was nice enough to share the Trading Pub. Actually, let me repost it. Whoops. The 8 gap facts has 8, actually more than 8, very specific data-driven data points that you can keep in mind of facts about the gap. Here's the most important one. I told you 70% of all gaps will fill that day. Here's actual data. You can see by year since 2002 through 2012. I think that's actually 11 years. I was trying to show 10 years, but you got an extra year there. So you see the number, you tend to end up, and these are gaps of at least 1 point in the ES. That's equivalent to about 10 cents in the spider. So I ignore the small ones. So this is not overly influenced by tiny gaps that only a tick or two. This is at least something tradable. And I will trade as small as a 1 point gap or 10 cents in the spider. And you see basically average about 225 out of 252 trading days a year. You have a tradable gap, and you can see the percent of those that fill the same day they are created. On average, about 70%. I trade the ES primarily. I do not trade the ETFs. Nothing wrong. They're highly correlated. You can use the leverage, simple leverage of futures. It has tax advantages. It's just a much cleaner, easier way to trade, in my opinion. You get the leverage. If you have an edge, you want to exploit that edge. You might want to start off with the spider, but you may want to evolve to include margin or options, or even move up to trading the futures. Okay, so that was the good news, right? We're all excited. Let's go trade the gap. Let's go trade them all. 70% chance of being a winner. Not so fast. There's the problem. I call it the paradox. Remember I told you profit factor. Anything greater than 1 has made money. Anything less than 1 has lost money. So a profit factor of 1.1, by the time you try to trade this, including commission slippage, execution errors, missed fills, life events, vacation, funerals. I had to go to a funeral last week. You're not going to make any money. You're going to lose money when you include all of that. So you cannot trade all the gaps. And that's because the markets are so efficient. The 30% of gaps that don't fill in a given day have a very high probability of filling on this subset. Correction. The 30% of gaps that don't fill in a given day have a very high probability of continuing significantly in the opposite direction, which counters or the profits you made on the 70%. So over the long term, you don't make any money. Markets are indeed truly efficient. And here's the other problem. It begs the question, well, Scott, why don't we just use stops? I'll find a nice tight stop and make a ton of money. Well, it doesn't work that easily either. I wish it did, I really did. But look, this is showing using a percent of the size of a gap. So let's say there's a dollar gap, which is a significant gap in the spider. And you use a stop equal to 25% of the size of the gap, or 25 cents. Historically, that scenario has only had a 20% win rate. Now, if it fills the gap, those that work, you made 4 times as much as you risked. You still don't make any money long term. Profit factor 1.04. The other side of the coin down here is this shows using a stop equal to 2 times the size of the gap. So let's say let's go the opposite way. Say it's a 25-cent gap in the spider, and you use a stop equal to 50 cents, twice as big. Has about a 65% chance of filling, but your average winner versus loser is off. And these are actual numbers here, right? Not everyone fills or gets stopped out. Some finish the day somewhere in between. That's why the math doesn't work out maybe exactly like you'd expect, but these are actual numbers from actual back testing. And you see you had a high win rate. Unfortunately, every time you're wrong, you got hammered, and you end up with, lo and behold, almost the exact same profit factor. To me, it's staggering, quite frankly, how efficient the markets are. But those are actual numbers. So I say we've got a couple of questions. I want to make sure I stay up with the big picture and I'm not missing anything. Yes, I'm going to get into what I cover in just a moment. And I don't trade individual stocks. I do provide a system that you can evaluate gaps on stocks, but I don't trade them. I just find I do better trading the large indices that have a natural reversion to mean. Because on any given, think about it, the S&P 500 out of 500 stocks, there could be sectors that are filling at an 80, 85, even 90% win rate for days, weeks, months on end. Of the same token, there may be sectors that are really trending, strong momentum, and they're filling at 50 and 60% win rate. So you really got to stay on top of what's working and what's not. And for me, it's just easier to trade the broad basket because it's very hard for a single piece of even economic news to, certainly very hard for a single earnings announcement to move or cause an opening gap that is sustained for that entire day in such a way that the gap does not fill. Yes, we've got some good news about gaps. It's coming. Again, I think 10 cents on the spider is as small as you want to go, personally. All right, let's continue. And I know some people are joining who may miss it because I'm covering a lot of ground. I think it is being recorded. You can download the slides on the link that I've posted a couple times, mastergap.com/tradingpub. And Morgan will have the recording for you as well. So regardless of stop size, it's still a break-even strategy. So what is the key to success? It's all about selection. One of the biggest breakthroughs in my mind conceptually was, instead of trying to capture all the winners, I decided to focus on avoiding the majority of the losers. So I had the wind at my back, but if I could just identify those characteristics of gaps that have the lowest probability of success, right, that 30% that don't fill, and focus on avoiding them, yes, I'll miss a bunch of winners, but my win-loss ratio and my profitability is going to be successful. That was the premise, and that's absolutely the way it's played out over the past 10 years. I've been very consistent. I saw someone mention that. I didn't recognize the name, but I appreciate the nice words. I am extremely consistent. I'll show you my numbers in a bit, but it's because I'm very, very selective. So this is how I trade gaps. Again, you need to trade gaps in a way that makes sense to you. Here's the information I use in my general conceptual approach. There's no way I can possibly cover everything that I do, but I'll cover the high level and answer your questions, and certainly show you how to get some more information at the end. So I trade like John Venn, right? Many of you probably recognize this is a Venn diagram where you have the intersection of many different data points. That's exactly what my brain does every single day. I am asking myself, evaluating each gap from different angles, these different data sets. And I'm looking to trade gaps only where the majority, if not all of the things I look at, show at least a neutral, if not a highly favorable setup based upon history. It's that simple. Think of it this way. I'm going to only trade when I'm on the right side of history. I don't trade if the setup has not clearly been historically attractive. Yes, I'll get some stats in a bit. Oh, hey, Rob, appreciate nice words. So how I select gaps to fade. The foundation of what I do are zones. That's what I'm going to be talking about the most of the next few minutes. And I'm evaluating that opening zone where a gap occurs relative to the current market conditions, current patterns, and current seasonality. There's no way I have time to go into all of this in great detail, but I want to share conceptually, because actually, nor do I need to necessarily go in all the details, because my secret sauce, my magic that works, is not the fact that I have the best filters. In fact, I honestly believe, I think I've got good filters, but it really wouldn't matter as long as these were distinctly, logically different, or low correlated concepts, which these clearly are. And let me describe. Market condition. I'm looking at what's happened over the past 2 to 8 weeks. You can do it. Think moving averages. Has the market been rallying? Have we had a pullback during a bull market? Have we had an extreme rally during a bear market, and so on? You can evaluate, define, if you will, every different type of market condition and put every single gap historically into one of a number of buckets, and I have about 10. Patterns. I'm looking there, instead of looking at the bigger picture of 2 to 8 weeks, I'm looking just at 3-day patterns. Has the market been rallying for 3 successive days? Has it been selling off for 3 successive days? Has it been up, down, and up, or vice versa? Seasonality. Seasonality is a little bit of a misnomer, but I use it to describe, is today a Monday or Friday? Or is it somewhere in between? Because Mondays and Fridays have very distinctly different characteristics. Think about it. The market's been closed. Traders come to work on Monday. Their systems have reevaluated the markets based upon where the market's closed on that prior Friday. There may have been some event that happened in Europe or announcement that came out in Japan and so on, and it's going to impact the market. And Mondays tend to be the riskiest day. So there's a nugget. If you had to pick one day not to trade, it's generally Mondays to trade the opening gap. Where the other side of the coin, Fridays are generally the best day to trade the opening gap. Now that's a little bit of a moving data point. Fridays used to be a little bit weaker about 5 years ago, but over the past 5 years, they performed really, really well. And I'm not exactly sure why. It may have something to do with weekly options coming into play, but regardless, Fridays are the best day. So there's another nugget for you there. All right. This does not apply. Let me say, you can apply it to Forex. I've never applied it to Forex. The problem with Forex is there's a very liquid markets, basically 24 hours a day, right? So there's an opening gap, I think, each weekend, but I've never tried it on that. Other than that, stocks, agricultural products, gold, oil, they can all be traded, these concepts, and many folks that follow me do that. I just prefer to focus on the S&P primarily, and the Russell. Gap zone. So what is an opening zone? Let me break it down for you. So this is a daily candlestick, right? And there are four levels. The day's high, the day's low, and then there's an open and a close. And I'm looking at those four levels each day. They're plotted on my charts. And those four levels create how many zones? Five. One, two, three, four, and five. Location makes a huge difference, and I'm going to prove it to you. Just one more slide. I thought it was this next slide. Here's why they work. They inherently incorporate support and resistance, right? These were proven support and resistance lines from the prior days. In fact, those four levels are arguably the single four most important levels on any chart because think about it. The Fibonacci's are derivatives, pivots are derivatives, and so on of those open, high, low, and close levels. So the five areas, again, are above the high, between the high and the close, number two. Number three is between the close and the open, between the open and the low, or below the low. Five zones based on four levels. They also naturally incorporate short-term trend if you look at the direction of the prior day, right? This closed up, so short-term trend was, you could argue, up. Gap size is built in. A gap below the low is going to be a bigger gap almost always. Well, by definition, almost always, than, say, a gap just above the close. And trader psychology is built into these as well because these levels are where folks often place their stops and their new entries. So by including the direction of the prior day, which it's simple but highly effective, you can actually create 10 different zones. That way you're capturing the short-term trend. And I would only do that if the data suggests it's worth doing that. Let me show it to you. I see David used the question mark, which makes it a little bit easier to see the questions. Yes, you can use options to trade gaps. I don't do that, so I don't have first-hand experience. There's a quote on my homepage that we just added at masterthegap.com where there's a lady you'll see, she's just finished her best year ever, and she trades primarily options. I don't do that. I think you have to be in the money and probably works better with some of the bigger gaps. But those are my thoughts. Okay, so here's the actual past 10 years or 11 years of data for trading the opening gap by zone. And I know we got some people just joining, so just real quickly to refresh. This looks at the prior day is down, prior day is up. The gold line, big thick gold line, is my target, if you will, the prior day's close. 70% of all gaps, if you average all these gaps historically across 11 years, as I just showed a little while ago, 70% of those gaps will retrace back to this level or this level the next day. By incorporating the open, high, low, and close and breaking down those roughly 2,500 gaps, you can see the delineation in the win rate. 55%, the gap above the prior high, 62% between the high and the open of following a down day, 73%, 81 and 66. Clearly, the closer you are to the prior close, the higher the odds. In fact, the very best is following a down gap is another gap down, which is often scary, that opens inside of the low of the prior day. And vice versa, if the gap is up, the very best is a gap that opens between the prior day's high and the prior day's close. And the reason, the psychology is real simple. Big money, even the market's uptrending, right? You have a big green candlestick. The next day you get another gap up. Does big money want to buy a gap up after the market's already moved up the next day? And do they want to buy that gap up no matter what the reason is? Do they really want to buy that if they don't have to? Especially when that overnight move, that move that's gapping up, was based on much, much lower volume. Obviously, the answer is no. If anything, they're going to stand aside or even short the opening gap, and that's the move I try to capture, and then they'll buy it around gap fill or maybe just a little bit below, shaking out the weak hands. Yeah, they want the better price. That's really, in fact, that's probably, if you had to remember one thing of why gaps work, that's it. The overnight moves based on low volume. Big money wants the better price. They're not going to chase. It's that simple. So here's a tip. I told you I want to give you actionable nuggets. Trade, or I should say don't trade Trade the higher probability setups. That doesn't mean you're going to necessarily make money. I'm going to get to my targets and stops or my stops in just a bit, because that's an important part of it, and paying attention to market conditions and the pattern and other filters to further refine these, day of week, et cetera, is helpful. But at a minimum, one of your takeaways, hopefully from our presentation right now, is stay away from these gaps. Do you really want to short a gap up that opens above the prior high after the market closed down, or vice versa, a gap down 53% that opens below the prior day's low after the prior day was up? I don't think so. It's a 50-50 trade. Could go either way. There's no clear historical edge. Doesn't mean you can't trade. It just means, that you got to know the wind's not at your back anymore. So I call these blood gaps. Yes, I know that is not how you spell blood, but that's an acronym. It stands for below the low of an up day. Below the low of an up day. So this was an up day, a higher close. Simple way to define an up day. Green candlestick. If you gap down below it, avoid it, because what the two types of sellers that are going to show up. And let me just take a sip of water and somebody tell me what are the two types of sellers going to show up on that blood gap? What are they trying to do? Those are categories. What are they doing and why? So breakout traders, there's one. So there are people trying to get established short, right? This may be a sign of a change in direction of the trend. You finished up and then you gap down below the low of an up day. So you've got speculative short sellers and you've got panic. That panic, the ones that are the new short sellers, they're not panicking, right? They're greedy, they're excited. The panic comes from the people that have been stuck long or that were long, and all of a sudden it caught them off guard and you get a big ugly gap down. They've tightened their stops, or maybe they don't have stops in place, and they're going to panic, some of them, and sell or close their positions. So it's that double whammy, if you will, highly technical term there, but that's the double whammy that keeps this blood gap from only filling at about a 50% rate. So let's talk about entry timing. I do something, again, a little bit non-traditional based upon a number of reasons, which I'm going to explain. I enter specifically at the open of the cash markets, or the regular trading hours in the futures, if you will, 9:30 a.m. Eastern time. Actually, before I get into that, a good question. Bruce says, can you short blood gaps? Yes, you can. I generally like to wait for a rally to the low of the prior day, or like a midpoint, a half gap fill. Because often those, they will rally some, and then you take the first break of a trend line or the first test of resistance to try to get short. And Gunnar, that's exactly right. You can look to, but remember, it's still a 50-50 trade. That's the problem. It's a 50% chance that gap is still going to fill. So I don't do a lot of follow the gap scenarios. You certainly can do it with momentum stocks and so on, but I'm more of a fader. I'll just do a day trade intraday. I actually trade probabilities using the 15-minute range and the first hour range. That's a topic for another day. Exact same concept I'm sharing here. I added opening ranges a couple years ago after doing nothing but gaps for 6 or 7 years. So I enter at the open, 9:30 a.m. I used to even be apologetic about it because I felt like, oh my gosh, I'm supposedly supposed to be this good trader, and I got people following me, and I literally would apologize that I'm not very good at day trading and so on and so forth. What I've actually realized is that it's that fear that presents the opportunity. Most people, most systems, most big money. Mark Chaikin's a good friend of mine, Chaikin Money Flow, Chaikin Oscillator. He befriended me. He's a big gap trader. He waits until 5 minutes after the open. Well, that's the opportunity. That creates the opportunity for those of us that have data to enter at the open, because often that is going to be the extreme move of the day, and it's a great time to enter. But there are other advantages as well. Simplifies execution, right? You just know exactly when you're entering. I'm not waiting there, sitting there with a nervous finger, when do I pull the trigger? I just enter the open. It's a binary decision. Is it a strong historically based setup or not? If yes, I pull the trigger at 9:30 a.m. Eastern time. If not, I don't. Minimizes emotion. The market moves a lot slower on lighter volume prior to 9:30, and then once that opening bell hits, it takes off, and emotions can really get the best of you. Takes advantage of rookie psychology. There are a lot of rookies, amateurs, that will chase those moves. They think, oh my gosh, that was fantastic news that just came out on the monthly jobs report. I know big money's buying here because this economy is doing great, so I'm going to buy this big gap up, then they get their head ripped off. So they're actually bidding the thing up in the pre-market, trying to front run the big money completely on the wrong side of it. So that often I'll even have, this is almost unheard of, a lot of people don't believe me, but I have positive slippage using market orders at 9:30 a.m. about 20% of the time, positive slippage. It's easier to back test. That's one of the reasons I started off doing it that way to begin with. That way I keep my data nice and clean and consistent. Focus the effort on the system, not me, which is really important because it's not relying upon me trying to pull the trigger at just a precise time, just when that moving average crossover triggers, or you get the squeeze breakout, or you get a tick extreme or whatever. I don't have to time it. Jeff says, do you enter exactly at 9:30? I actually enter my preferred way. I actually trade multiple accounts and multiple brokerages, and it's sort of a pain. But my preferred way is to use the time-activated order functionality that TradeStation has, and I enter at 9:29:59. 1 second before the open is when my order is submitted. Now, if I manually do it, I'm still trying to place the order 1 second beforehand. That has worked. That's actually cut down a little bit because sometimes you do get negative slippage. So 1 second beforehand is what I'm trying to do. Now, you could enter 5 minutes beforehand. You can enter 5 minutes afterwards. The key is to be consistent. And the last benefit is it catches all of the winners, meaning so when Mark Chaikin and I compared notes, we had comparable profitability. He had a higher win rate, and I caught more winners. So he was missing the easiest, best trades because the market would start trading immediately, and he wouldn't chase the market. It had to be going against it at the open. So I'd catch a nice 5-point win that started filling immediately at the open, and by the time he got in, he'd either miss it or he would get a smaller return. Now, the other side of it was he had a little bit higher win rate because he gathered that extra information for 5 minutes. And the reason I'm sharing this, again, is not to confuse you, but to say you can trade however it makes logically sense to you. I'm telling you what I do and why I do it. So let's talk about when do you get out. Nice segue. When do we get out of the trade, right? I've never made a dime, and you've never made a dime entering a trade. We only make money when we get out of the trade. It's the exit. So where do you place the stop? Actually, let me first say, I'm targeting, I don't have a slide on this on targets because I knew it was going to be tight on this, but let me talk targets. I'm generally targeting gap fill, the prior day's closing price. So the prior day's closing price, either 4 or 415, depending upon if you're trading ETFs or futures or stocks. If it's a very strong setup and the gap is somewhat small, say less than what I call a smaller mid-sized gap is somewhere between 1 point in the ES up to 40% of the 5-day average true range. Now that's sort of an earful there, but 40% of the 5-day average true range. Those are small and mid-sized gaps. If it opens in that area, it's good. It's a much higher probability than even 70%. If this for pretty much every trade I take, based upon my multi-factor analysis, and that also means it has a much higher probability of hitting the extended target, a point through gap fill, beyond gap fill. So just imagine this, the words here represent the prior day's close, and the gap is up. I may scale out on a good setup 2/3 of the position at gap fill from my entry all the way down to the close, and I'll hold 1/3 for a point beyond gap fill. And that amount I use, it's a mathematical number. It's not optimized. It's just a good solid target, is equal to 15% of the 5-day ATR. So I will routinely take, say, a 2-point gap and milk it for an extra point or two to turn it into a 3 or 4 point win on the best setups. So that's the target. But generally speaking, starting out especially, you want to start out at gap fill. On stop placement, let's talk about where to put the stop. Where is your protective stop go? Remember this slide? The stop dilemma. Small stops does not improve profitability. Doesn't hurt it either. It just impacts win rate. So I tell people all the time, you need to sort of back into whatever win rate you're most comfortable with in your risk-return ratio. A lot of people don't like risking more than they stand to make, and that's fine. you'll have a higher win-loss ratio. You'll just have a lower win rate. For me, the way to make money is to trade a system that you can actually follow and stick with it through thick and thin. And for me to do that, it has to be a high win rate system. So I'm targeting to have a 65 to 70% win rate year in and year out. Because I know if I do that, the mathematics of it is that I will rarely have more than 3 or 4 consecutive losses in a row. In fact, I've only had 2. I've actually personally only traded 1, but it happened a second time. I was at a doctor's office, so I missed it. 5 consecutive losses that have only happened to me twice in almost 10 years. So by trading a high win rate system, I'm only enduring during the course of a year maybe a 4-point loss, a string of 4 losses in a row once or twice a year at most. I had, I think, 1 time last year, and that was in September. I went 0 for 4 in September last year. It was a terrible month. Thankfully, I've been on an absolute tear since then, and I've got good money management. The point is use a win rate that makes sense to you. So that's how you need to place your stops. Figure out if you need a high win rate system, because if you're only trading 1 or 2 markets, a couple setups, you're really dependent upon them. You probably need a high win rate approach. If you're trading multiple markets and multiple setups, then you can get away with these lower win rates, and you make the same amount of money on each. Now, again, you're going to make a lot more than this. We're not trading them all. I'm being very selective. So here's what I do. I use, on average, my starting point is 30% of the 5-day ATR, 30% of the 5-day ATR. Anywhere from 25 to 40% works in most markets, depending upon the volatility of the security. That equates to roughly 50 to 80 cents in the SPDR, or about 5 or 8 points in the ES, the E-mini S&P 500. If I increase stop size to accommodate volatility, then I always reduce my position size, right? Because you got to back into there's certain dollar amounts, percentages that you ought to be willing to lose, and no more than that. Okay, so if you have to use a bigger stop because of volatility, then use I do fewer contracts, so that I stay within my max loss tolerance. But the good news is the average winner when the markets are volatile tends to go up proportionally as well. And I never hold losing trades overnight. And here's another little nugget for you. A gap that doesn't fill on a given day, regardless of whether it was up or down, has a very low probability of filling on the subsequent day. I'll say it again. A gap that doesn't fill on a given day is a sign to the market that there's a change of character in the market, and it's probably not going to fill the next day either, meaning prices aren't going to do an immediate reversal. It happens, but it only happens about 25% of the time. So 75% of the time, you're going to only endure more pain the next day because you're still in the long trade. If the gap was down, it didn't fill. Maybe you got greedy thinking, oh, we're in a bull market, I'm going to hold on to it. I'll probably fill tomorrow. No, do not do that, because 75% of the time, you're just going to end up with a bigger loss. At least that's what the math shows, okay? So stop size is really more of a personal preference and a profitability determinant. I got to motor through here. So I just see a question, why is the overnight trade coming to the discussion of gap trade? It's the overnight action that creates the gap, right? It's the overnight action that creates the gap. So I'm trading the gap. I will hold it all day. So we talk about stops. I have a time stop that ends at the end of the day. And I'm suggesting the data shows you, not suggesting, I'm telling you, the data shows I don't ever get greedy and try to change my mind and say, well, I'm underwater, it didn't fill the gap today, I'll wait till the next day. I don't suggest you do that. Data says you're going to get hammered. But I'm not an overnight trader, by the way. That's not at all what I'm saying. I trade intraday when the volume is highest. Market's more liquid, and so on. Less slippage, more predictable. So some of you asked about some of my own results. I want to be clear again. I'm not sitting here pounding my chest saying I'm the best gap trader ever. I am very consistent, though. There are a bunch of people who have followed me for years. I post, not only do I call, I actually type up what I'm going to do. Before I do it, I've done it for about 5 years now, posting the specifics of, am I going to fade the gap or not, my target, stop, rough position sizing, and so on. And you can see I've traded about 170 times over the past 2 years, which is about 85 times per year. That equates to about 1 out of every 3.5 days. Once every 3 or 4 days, I'm taking a gap trade. Not because I don't want to trade much, it's because that's how frequently the markets tend to give a strong historically based setup with a clear edge. If I don't have a clear edge, I pass. I'm not a gambler. I'm in it to win it the long term, not on a given day, not every week, not on a given month. I'm all about trying to maximize my long-term returns by being very consistent and minimizing my drawdowns. Uh, so I've averaged right around 65% win rate historically. Actually, that's the thing I'm most proud of. And my profit factor, that varies quite a bit per year, and your returns are going to vary tremendously. You'll see some people, actual emails that I've gotten that are posted on our website, even recently, where people made 50, 60, 70% returns last year in the accounts trading the gap. I didn't, because I don't risk that much. I would trade much more conservatively. So the profit factor just means my actual results showed 28%, my profits from my winners were 28% bigger than my losses. Again, there are plenty of people that can do better than that, but normally it's a function of leverage. And you know, I don't spend a lot of time staring at the markets all day either. I don't have to. I make my decisions, for the most part, leave them alone. I do have some rules I don't have time to get into now when I may tweak a stop or target, but for the most part, I just follow the data. And to be clear, again, this overnight thing is confusing people. Overnight action, I watch the futures in the overnight to see where the markets are going to open. If it's going to open in an area relative to the prior day's close that is attractive, then I will enter at 9:30 and trade the gap right then. So to summarize, and I'm going to show you how to get some more data in a free presentation that shows you 8 specific research nuggets, if you will, which I call my 8 gap facts. To summarize, historical probabilities level the playing field between the pros and the Joes. You can be a master at discretionary chart-based trading like Steve, the prior speaker, but it's going to take you years, many years. So I was fortunate enough to realize that early on, and I realized I could supplement my lack of day trading experience, my lack of chart reading experience by simply using historical data, and that's what I and hundreds of members, folks around the world that follow me, do. We use historical probabilities to level the playing field and to identify what big money's going to be doing. It's all about selection. Know the zone. That's, in my mind, the most important thing to consider when evaluating a gap. Entering at the open has many benefits, as I showed you. It's not the only way to do it. And use a stop size that fits you and your desired win rate. So what works for me may not be optimal for you. If you'd like to learn more about gap trading using historical probabilities, you can join me at mastergap.com. Or consider, and this is especially if most of you are, I'm guessing, are either new to gaps, that's why you're listening, or you're new to trading with probabilities. If so, then you may want to consider a professionally recorded DVD set. I did actually went into a professional studio with a professional moderator and organized all of my research and concepts together in a way that was manageable, useful, and that builds upon itself. So I'm really proud of it. I've sold a ton of these, and I've sold many of them at 500. If you purchase, use this link here, and you purchase by March 15th, you can, and important, ding, 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 and use the keyword or coupon code PAY97 on the checkout page. You'll get them for 97 bucks, and there's a 30-day money-back guarantee. So if you get them, you look at them, and you're disappointed, and you didn't think it was worth the money, then return them, okay? I'm not trying to rip anybody off. That's not my style. I went to West Point. I'm a hardworking guy. I'm very meticulous. I have a unique approach that's proven to be very valuable for many people, but I recognize it may not work for you. So you can't lose anything there. It looks like, let me just show you, when you go to this page, if you're not there already, oh, hold on, you can't see that. It looks like this. So you can get these 8 gap facts. This is 21-minute video, real hard hitting, to the point, builds upon the information I just showed you. You'll get a copy of the slides that I just shared with you, and you can click down here to learn more about the DVDs. Okay, don't forget, pay 97. And let's see. That's it. Quick questions. Let's see. Oh, appreciate the nice words. Opening zone, Dave, you're probably going to need to go back and look at the recording. I spent a fair amount of time. The opening zone is simply relative to, super quick, not to leave you hanging. Opening zone is where the market opens relative to the prior day's high, close, open, and low. So you look at the prior day's bar, and these 4 levels create 5 zones. No case studies. Monique, every day I do a video, about an 8 to 10 minute video. It's posted on my website for free, and it is a case study of that day's gap. I break down the good, the bad, the ugly. You can go back. In fact, our members, you can go back to see every video I've done over the past 5 years, and I show you what I posted in the morning, what our research showed. My database presents the research each night for our members. I show you my written plan, so there's no getting around what I said I was going to do. And then I show you the charts and I explain what went wrong or what went right. I don't trade the YM. I'm not a big fan of the YM. I think it's sort of a hunting ground for pros to take money from the Joes. ES is more liquid, smoother movements. I think this YM sucks you in with that $5 per tick thing, and I just say buyer beware. Yeah, I had to go with the math-based approach, T. Bates, because I knew there was no way I was ever going to catch up and accelerate my learning curve fast enough to be able to make it as a discretionary chart-based reader. I'm a big believer. Anyone that has read Malcolm Gladwell, wrote the book Outliers. He has something called the 10,000 hour rule, and all the experts in the world in any field all have one common trait. They spend at least 10,000 hours of time on the subject matter that they're an expert in. And I realized I didn't have 10,000 hours to figure out how to day trade. So